Rangel, Sotheby's International Realty. We're doing our 4th podcast, so awesome. We have brought a new recruit,
special guest,
special agent, Matt Scott.
Red carpet,
Scott,
man.
And here to...
I'm still looking for that.
You got purple wall?
Yeah, exactly.
Purple wall.
New look.
What do you think? Yeah.
Exactly, enjoy. So today we're going over, a topic that we've all dove into many times and talked about is insurance. There's so many different levels of insurance we all deal with on a daily basis: health, life, home, you name it. It seems like auto. It's insurance that can cover pretty much anything you own. It seems like. I think you get insurance on your employees too if you wanted to.
Apple insurance, you name it.
Exactly. So more importantly and relevant to us in our industry is homeowners insurance. And there's a myth that because of the natural disasters, the fires in particular, that insurance is not attainable in certain areas. And we're going to be honest with you, it is difficult in some spots because of the new zoning and fire zones that have been designated. However, it still is obtainable. It's something that you can get. It's just being diligent, making sure you're shopping around first and foremost before you go too far with the property that you're looking at, and understanding what some of the challenges are and why in particular areas geographically. So we have a good crew we work with, insurance agents that help us get in front of these things for us and our clients, so we know when we're looking at a property within a certain area that we're going to anticipate some possible challenges. And if we are lucky enough to be making offers on those properties, making sure that when we're in contract or moving forward with the purchase, that our clients are well informed about what the insurance costs are going to be. So all part of the process, and even more so on the insurance arena too, is mortgage insurance and other layers of insurance that we're talking about. So kind of what you guys are dealing with on FHA buyers, or even some conventional buyers who are putting the full 20% down.
Yeah.
So
that's great stuff, and I'm sure Matt, you could probably share some things about insurance and your experience there. You've got a wealth of knowledge, but just speaking on that point of I think the problem is that as a buyer you're looking at you hear about insurance that you need, and then you also have mortgage insurance, and really understanding the difference between what mortgage insurance is and what hazard insurance is are really two different things, right? So hazard insurance are what are going to protect you if something were to happen to your property, all right, where the mortgage insurance is a risk to the lender for putting down less than 20%.
it's basically protecting the bank, right?
Correct.
Yes.
Exactly.
Yeah. Whereas the hazard insurance is your fire insurance.
You're protecting yourself.
Protecting yourself and your assets,
you're
right.
protecting the bank as well.
Correct.
It's mandatory that you get
Right.
it anytime you have a loan.
Right.
You have to have hazard insurance.
And so, Matt, and you are somebody who really understands a lot from your personal experience
Yes.
about what it's like to really understand about insurance. So share your story. Please do.
Will do. I lost my home in the Tubbs fire in 2017, and it was a learning process. Not only because of insurance, but also really understanding the different types of insurance that you need. Now, when you get hazard insurance will cover if you have a fire, if a bolt of lightning comes by and strikes your house, if someone's car drives into the side of your house. Those types of options will be covered. However, if you have a certain other type of calamity, let's say flood, that's not covered by your hazard insurance. And if you live in what is known as a flood zone, with any lender, you do need to ensure that you have separate flood insurance. It also, in the state of California, does not cover earthquakes. Now, it's not mandatory that you have earthquake insurance. Doesn't matter where you live in California, that's never mandatory. However, I have worked with individuals who do want to protect their homes in case of an earthquake. That is a separate line of insurance that you must pay as well.
Right, that's like a state subsidized, right, in policy, the earthquake. Isn't it something where it's our state program, right? It's not an independent, like you're...
No, you can get it through an independent.
Oh, you can?
Yes,
Okay.
yes.
So,
And I found, the conversation is coming up more and more with people wanting earthquake insurance. I know, just people in my own family are asking, hey, I really need to get earthquake insurance. Obviously, the fact that we have an earthquake here in California overdue as much as it is.
It's a volatile world,
Yeah.
and our climate is on the knife's edge right now, let's face it. So there are a lot of people who are trying to be preemptive. So that's what insurance essentially is you being preemptive or some other entity being preemptive in case of something disastrous happening.
Right. Yeah. Hedging against some potential concerns, and I think we all, have that. There's experiences we've gone through, like yours, the wildfires, and then you're experienced and aware of how that particular event impacts, or how insurance impacted you in that particular event, and knowing now too what you went through, I think it makes you a little bit more open to looking at other possibilities too. The flood insurance, the earthquake. Okay,
Yes.
what else? Let's look at our policies. Let's dissect them and see what within the policy do I need to really understand better, or maybe perhaps increase, or even outside of that too. What can I do to help just even mitigate the cost of the insurance, right?
Yes.
Like the homeowners doing some preventative, what I call it, defensible space around your house for fires and things like that. So really important to, or I'm glad that you're able to speak on that, because I think it's so important to be proactive no matter what area you're buying, to know. If you're in a hurricane area, right? Understanding your hurricane insurance. There's just natural disasters.
You better believe it. It's ubiquitous. Natural disasters happen everywhere. But beyond that, you also have to think about the cost to rebuild if you lost everything. And that's where, unfortunately, people get a bit short-sighted. They look at one plan that might cost $600 a year. They look at another plan for $700 a year. That plan for $700 a year could possibly cover all their costs to rebuild, but they're so concerned about saving that $100 a year that they end up getting a lesser plan. And in this volatile world, I would strongly encourage people to really evaluate their plan and making sure that if something was to happen, that they could become whole again. And that's the term that you hear so much being bandied about in the insurance world, is being made whole again.
Sure. Yeah. Right. Makes sense. Well, cool. Well, I think that's good. Do you guys have anything you want to add to it?
Well, mortgage insurance, real quick, that Joe was talking more about. If you have, if you are buying a house, and let's say you're coming in with 20% down or greater, you don't have to worry about mortgage insurance, which again protects the lender. However, if you are putting 19% down or less, you do need mortgage insurance.
So devil's advocate, why would I want to protect the lender? Or why would the lender want to be protected? What are they being protected from?
What it comes down to is the agencies like Fannie Mae, Freddie Mac especially, it's about protecting the loan so that if you were to default, then they're covered.
They would file a claim, and then the lender could.
So the most important thing to understand about that is it's a very lots of layers of evaluation in the risk, and and that's tied to the amount of the premium that you're going to pay. So depending on if you're a conventional loan or an FHA loan, what they're going to also, those two different programs will have different premium factors. So
credit score,
down payment, debt to income ratio,
right?
All of those factors come part of it. Now, one of the cool things that we do here, and I think it's very important, and not all lenders do this, is we'll shop every single mortgage insurance company to ensure that we're getting actually the lowest rate on the mortgage insurance premium. So when you're planning and you're getting pre-approved, understanding the difference between what mortgage insurance is, and the need to have hazard insurance, and how those premiums are kind of calculated is going to make a huge difference in what you can qualify for. So really, this really comes into the preparation.
Well, and also on this too, if you have mortgage insurance, how to get rid of it,
right? Absolutely, 100%,
right?
100%.
Once your equity hits a certain point,
definitely,
dropping your payment, right? Just getting rid of refinancing, I guess is the way to do it.
Absolutely. Yes. So a lot of the time when we're meeting with that buyer and getting them pre-approved and we're having that conversation about the mortgage insurance, we're already talking about the plan to have it removed.
Yeah.
So
in 12 months.
Right. You look at this transaction and this purchase, you always want to think of the transaction ahead, whether it be a refinance or it be a paying down of the principal balance. You know, you can't count on necessarily equity always climbing, so you do want to account for what could happen in the market. So that's where yourself as a realtor,
Good point.
kind of giving your market analysis on, what things are going to look like in the next, year, 2 years down the road, trying to give a projection, things like that.
Yeah, balance being paid down, market increasing, and where are you going to fall within that to be able to hit that point where you can get rid of your mortgage insurance? Yeah.
Right, and then also the disclosures will show too.
Right.
The
Amortization
lean out.
schedule. Yeah.
Exactly.
Yeah,
We'll
right.
actually show and depending on the scenario, it could be 5 years, could be 10 years, when that mortgage insurance would essentially fall off.
Yeah.
And I don't want to seem like I'm talking out both sides of my mouth. When it comes to hazard insurance, think about quality, not just always the cheapest policy. But when it's mortgage insurance, you don't care. You want the cheapest policy.
Thank you. That's a great one, right? Yeah. We don't care. We want to get you the best rate, and
Right.
also a lot of the times as you're prepping, because there'll be a huge difference, right, between
Most certainly.
a 699 FICO score means you're middle of your 3 scores if it is 699,
Right.
and even a 700
Yes.
can be a huge difference in
We
what
talking
you're
about
actually going to pay monthly.
hundreds of dollars, or
Depends on the loan amount,
Depends.
right? So it depends on the loan amount.
Sure.
Depends
Yeah.
on that FICO score and all of those. So yeah, no,
Income ratios.
But it
well.
could be a couple $100s.
it very well could be. So what you want to do in situations like that, where we would look at how do we get you a point, 21 points to get to,
Right.
either 700, 720, or 740, because really
Scoring or-
we would be able to share how that matrix works and what would be how you could get to saving, an extra $100, $200 a month, to your point,
Right.
just by changing certain credit factors.
Most certainly. And you're also buying the same house essentially. So any way that you could think about tailoring the solution to your needs makes the most sense.
I like that. Good stuff. Thank you,
Taylor.
Yeah. Appreciate it.
Dan.
Thank you, Joe.
Joe.
All right, let's do it.
Good stuff. I hope you guys enjoyed. Make sure to comment or post questions. Reach out to us. We'll have our information just after this. So looking forward to hearing from you. Thank you.
Take care.
Thank you.